Ever wish there was? Like a simpler way to get smart about investing. Not the jargon, but what really works. Well, today we're diving into this great metaphor. Invest like a turtle, not a rabbit. And we're basing this deep dive on some really profound stuff from two investing legends. John C. Bogle, the guy who started Vanguard, created the first index fund, and Benjamin Graham, whose ideas are, well, they're basically timeless. We've got their writings, analysis, the works.
Yeah, and our mission today is really to get into why those patient, disciplined investors, the turtles, almost always seem to win out over the fast money crowd. We'll pull out some surprising facts, some really actionable stuff from these sources. Look at the traps of quick trading and, the real power of taking it slow and steady.
Okay, so let's start with a rabbit. We all kind of know this type, right? Maybe we've even been there. Always chasing the quick win, the easy money. It's almost human nature, believing past winners will keep winning. So you jump on the hot stock, the hot fund. But the sources show this just doesn't work out well long term.
Right. And the sources, they give us some, well, frankly, some pretty wild examples of this rabbit thinking. Remember the January effect, this whole idea that small stocks always popped in January. You're supposed to buy in December, sell in January, grab a quick 5–10%. But the thing is, it just fell flat repeatedly, but people kept trying it. It shows how much we want these shortcuts to work, even when the evidence says otherwise. And then you get these really crazy stories, like day traders pumping up the wrong stock just because the ticker symbol was similar. Total confusion. Or that analyst predicting Qualcomm would hit $1,000 a share. I mean, it was already up, 1,800% that year? Then it jumps another 31% in one day.
Wow.
Yeah. That's not investing. That's just, pure speculation. It makes you appreciate David Swenson's blunt advice. Ignore Jim Cramer. Pay attention to Jack Bogle. He was talking about advice on TV that just fuels that frenzy.
And it's tempting to think, oh, that's just individual traders. But what's really interesting in these sources is how even the professionals, the mutual fund managers, got caught up in this. Get this. Back in the 60s, maybe early 70s, shareholders held on to their mutual funds for like 12 and a half years on average. That was an 8% turnover rate. Today, it shot up to 31%. People are jumping in and out of funds much, much faster.
And the fund managers themselves, they kind of set the pace. Back 40s to mid-60s, their portfolio turnover was pretty low, maybe 17% a year. By the late 90s, it was up to an incredible 85%. That means they were holding stocks for, barely over a year?
Just over a year.
Yeah. Acting like short-term speculators, not long-term investors, managing other people's money.
Which is, as the source says, kind of odd, right? For people with a fiduciary duty, a duty to be careful with client money, all that trading just racks up huge transaction costs, and then there are the taxes. It's this massive drag on returns that people might not even notice.
Exactly. It's like the whole system incentivizes short-term thinking.
Okay, so we've seen the rabbit's frantic race to nowhere. Let's shift gears. Let's talk about the turtle. The slow, steady approach. This brings us straight to John Bogle and his really simple long-term philosophy. His big thing was, the secret of investing is, there is no secret.
No magic formula.
Just sticking to the basics.
And that fits perfectly with Benjamin Graham's core ideas. Graham always stressed that a stock isn't just, a blip on a screen. It's ownership in a real business. It has an actual underlying value separate from whatever the market price is doing that day. He saw the market like a pendulum, right? Swinging from crazy optimism where stocks get too expensive to unjustified pessimism where they get too cheap. The intelligent investor, Graham said, is a realist. Sells to the optimists, buys from the pessimists, but, and this is key, Graham warned against trying to predict those swings. His motto is basically, never buy right after a big jump, never sell right after a big drop.
Don't chase the momentum.
Exactly. Market prices are there for your convenience. Use them if they make sense. Ignore them if they don't. Don't let them dictate your emotions.
And that connects right back to Bogle's point about time, doesn't it?
Yeah.
He always said, time is your friend. Give yourself all the time you can. Start in your 20s.
Right.
Even with small amounts. Make it a habit. But why is time so important here? It feels slow.
Because time unleashes the miracle of compound interest. It really is like a snowball. The longer it rolls, the bigger it gets, and the faster it grows. Small amounts, invested consistently over decades, can become, huge sums.
Right. Your money starts making money, and then that money makes more money.
Precisely. It takes patience, but the payoff is potentially massive down the road.
Okay, let's dig into something often ignored. The cost of being a rabbit. The fees. You hear people say, It's only 1%, 1.5%. Does it really matter?
No, it absolutely matters hugely. Let's break it down. First, the obvious one, expense ratios. That's the fee the fund charges every year. Your average actively managed equity fund might charge, say, 1.5%. But a low-cost index fund, maybe 0.2%, even less sometimes.
Okay, so about a 1.3% difference. Still sounds kind of small year to year.
It sounds small, but think of it like a tiny leak in a pipe over 10, 20, 30 years. That constant drip adds up to a flood of lost money. It just erodes your capital. And that's just the stated fee. Then you have the hidden costs, transaction costs. These active funds, churning their portfolios 80% a year on average, all that buying and selling costs money, brokerage fees, market impact. The sources suggest this can easily add another 0.5% to 1.0%, maybe even more, to your real annual cost.
So wait, if a fund turns over its whole portfolio in a
What?
year, which some do,
Yeah, 100% turnover. One study estimated trading costs at about 0.8% per transaction, so that's 0.8% on the buy, 0.8% on the sell. That's potentially another 1.6% per year.
okay, now I'm seeing it. Add the 1.5% expense ratio to maybe 1.6% in hidden trading costs?
And you're looking at what the sources call an aggregate fiscal drag of over 3% a year.
3%.
Yep. So if the market returns, say, 10%, almost a third of that is gone before you even see it.
Wow. So for that active fund manager to just match the market after costs, they need to beat it by 3.5% before costs.
Exactly. That is a massive, massive hurdle to overcome year after year. Most just can't do it consistently.
And this is the tyranny of compounding, working in reverse.
Precisely. Compounding is fantastic for returns, but it's brutal when it comes to costs. Those seemingly small fee differences create staggering differences in your final wealth over decades. We're talking potentially hundreds of thousands, maybe millions, lost just to fees and the related drag. It's quiet erosion.
And then there's the other black sheep, as the sources put it.
Yeah.
Taxes. Funds often just ignore the tax impact on their investors, right?
Completely. All that high turnover generates capital gains distributions. The fund sells winners. You get hit with a tax bill, even if you haven't sold a single share of the fund itself.
Right. You get that 1099 form at year end.
Yeah, and it can really bite. A fund might show a nice 12% pre-tax return, but after taxes kick in from all those distributions, your actual take-home return might only be 8.5%. Active funds can be incredibly tax inefficient.
Okay, this all leads us directly to indexing, the ultimate turtle strategy, apparently. It's now seen as the benchmark, the standard, but it feels passive, like you're not even trying to win. Why does just owning the whole market work so well? Is it just costs?
Costs are a huge part of it, absolutely. Take the Vanguard 500 index fund. People initially called it Bogle's Folly. Can you believe it? Now it's massive. It just buys and holds all the stocks in the S&P 500 index. No expensive managers trying to pick winners, no analysts. That slashes costs. We're talking expense ratios like 0.10%, 0.15%. Compare that to 1.5% or 1.7% for many active or international funds. The cost saving alone gives you a huge head start. But it's also about market efficiency. The reality is, it's incredibly hard, maybe impossible, to consistently beat the market over the long run, especially after costs. So indexing just says, okay, if beating the market is so tough and expensive, let's just beat the market, capture its return efficiently.
And the numbers really bear this out.
Overwhelmingly. That original Vanguard fund. Over 15 years, it beat 94% of its active rivals before taxes. After taxes, it beat 97%.
97%.
Yeah. Plus, broad index funds are actually less risky than the average active fund. Their risk level was measured as 30% lower in one recent 5-year study, and as we mentioned, low turnover makes them way more tax efficient. Fewer surprise tax bills. Simplicity wins.
What's maybe even more convincing are the endorsements. You expect Bogle to praise indexing, but listen to this. Peter Lynch, legendary stock picker, right? He said most investors would be better off in an index fund.
Wow, from Peter Lynch?
Charles Schwab. Only about 1 out of 4 equity funds outperforms. That's why I'm a firm believer in indexing. Even the Motley Fool, known for stock tips, basically says index funds are the way to go if you've struggled, and we don't think there's any other fund out there worth buying.
That's pretty blunt.
And maybe the most telling. John Fossil, former chairman of Oppenheimer Funds, an active manager, he admitted, people ought to recognize that the average fund can never outperform the market in total.
That's a huge admission. And it really hammers home this idea of reversion to the mean. It's like financial physics. Just because a fund did great last year or even the last 10 years doesn't mean it will keep doing great.
Right.
Past performance is just not a reliable predictor. Think about Legg Mason Value Trust. Beat the S&P 500 for 15 years straight. Amazing run, right?
Incredible.
Then, boom, 2006 to 2008, it lagged the index by 43 percentage points, down 66% when the index was down 23%. It just cratered.
Ouch.
Yeah. And even those Morningstar star ratings everyone looks at, the research shows they have little predictive value for future performance. Hot streaks just don't last.
So this isn't just about numbers and strategies. It digs deeper into, like, our mindset as investors and also the structure of the industry itself.
Absolutely. Graham was wary of projections. He thought, investing on the basis of projection is a fool's errand because, well, the future's uncertain. He even distrusted complex math and finance, saying, the more complex it gets, the more speculative the results usually are. Simple arithmetic is often better. And a really crucial point from the sources is this potential conflict in the mutual fund business. The interests of the management company running the fund might not align with the interests of you, the shareholder. The structure often favors the management company. When profit clashes with that fiduciary duty, the duty to act in your best interest, too often, greed wins.
The profit motive takes over.
Right, which is why the structure of mutual organizations like Vanguard is so interesting. They're owned by the funds themselves, essentially by the shareholders. There's no separate corporate owner demanding profits, so any profits, which are really cost savings, get passed back to the shareholders through lower fees.
Which is why their costs are so much lower.
Exactly, about 75% lower than industry norms, according to the sources. Morningstar even found this direct link. The more the fund trustees get paid, the more the shareholders pay in expenses. It shows how structure impacts your bottom line.
It really all comes back to needing to educate ourselves as investors, doesn't it? Bogle was adamant about this. He said, individual investors must educate themselves. You have to pay attention, read the fund documents, understand the costs, demand transparency.
Because if you're not looking out for your own interests, who will?
So wrapping this up, the big message seems pretty clear. Be the turtle, not the rabbit. Patience, discipline, simplicity. Focus on what you can control, keeping costs incredibly low, using time to your advantage through compounding.
Yeah, the evidence just piles up. Passively managed index funds tend to win over the long haul, mainly because of those huge cost advantages and better tax efficiency. It really is, as Bogle put it, the triumph of experience over hope.
So here's something to think about. Looking at your own approach, where might you be acting a bit like the rabbit? Maybe chasing performance, paying high fees somewhere. And what's one simple step you could take, maybe starting today, to shift more towards that disciplined, low-cost, long-term turtle mindset? How can you make simplicity and cost-cutting a priority?